Last week, I asked you guys for help in spending my 13k that I have to put in the market. I'm scared of a market downturn as much as everybody else is.
Our core prediction at Bank of America is for a mild recession in early 23 to mid 23.
But I hold the firm belief that staying disciplined and staying in the market and dollar cost averaging all the way in is probably the best way to invest. I asked you guys to find some stocks for me, and you guys came up with a lot of suggestions, but one stood out way further than the rest. By far, one of the most recommended stocks was Zim Shipping, a stock I've never heard of. So today I'm going to do a quick stock analysis of Zim Shipping, and then I'm going to show you if I've bought anything this week. Welcome back everyone, my name's Paul, I'm brand new to investing and I started a dividend reinvestment portfolio on Trading 212. I'll be buying loads more over the next couple of months and deep diving into more stocks, so click the subscribe button if you want to follow more of my journey. Overwhelmingly, YouTube has recommended Zim Shipping Limited as the stock to buy. I've never heard of this stock, it's never come up on a screener, which means only one thing: Reddit must be recommending it. Could anything be more of a red flag? Zim Shipping is a global transport stock that made a lot of money through the pandemic because most of shipping out of China was blocked, as lots of ships were on slow travel or completely frozen, with tons of Bored Ape t-shirts unable to make their way to the US shores. We also had this thing where the Suez Canal was blocked and all they did was send a couple of tractors over to try and pull the ship out. This led to a decrease in the availability of ships and sent shipping prices soaring all the way through 21 and 22. Zim was one of those companies benefiting, with their ships full of US and Chinese cargo and no one could offload them anywhere, so they just sat there gathering rent. But I think many have been led astray by the mysteries of supply and demand, and when you end up with a lot of free ships and overinvestment, you end up with a massive price collapse. And that seems to be what has happened, as prices have fallen through the floor as shipping lanes have opened up. And what everyone's thinking now is, how does this affect Zim stock? Well, we can see on Fastgraphs where Zim did really well, growing at a ridiculous rate through 2021 and releasing good results on 2022. I even think they started giving back to shareholders in one massive dividend payout of 7.65%. Expectations going forward though are not so good, with shipping prices collapsing and Zim not looking like it has anywhere to go in the future. I imagine this is what's going to happen for a few years now while the world catches up, and that dividend is going to basically be non-existent. EBITDA and free cash flow are both collapsing as well, which means this company just is not going to make any money. The balance sheet itself doesn't look all that bad. A good ratio, excellent current ratio, with long-term debt to equity around 30%. So it doesn't appear this company is actually going to go bust anytime soon. The positive here seems to be that you have a price to free cash flow of 0.5 times, which is basically paying nothing for the company. But with the decreasing earnings and the poor forecasting, it doesn't look like it's going to be staying at 0.5 times anytime soon. That's all because of this decrease in free cash flow. What I think here is people are focusing quite heavily on this low PE ratio and the ridiculous dividend yield of 153.57%. That's obviously a trailing dividend yield. If this thing gets an excellent PE expansion, you're looking at 20% year on year, which is an excellent return. But if it all goes wrong and he keeps losing money, in the end it could end up quite badly. Unfortunately though, with this massive dividend cut coming, and it looks like it's possibly already priced in, but seriously weaker earnings coming over the next 3 to 4 years, I think there are way too many flags here on the downside. Maybe some lucky gambler can win big at some point, earning 64% a year just in the next 2 years, but this is a big nope from me. First rule of investing: don't lose money. So I won't be buying Zim Shipping anytime soon, which begs the question, what am I buying? For the latest addition to my portfolio, I've made a large investment into a company called Brookfield Renewable Partners. I spent a couple of weeks on the larger Brookfield asset management company and decided I'd like to invest 3 to 5% of my portfolio into the renewable energy side of this big Canadian investment firm.
Many companies, especially power companies, need to replace fossil fuel generation with renewables. So we are going to be helping companies and their balance sheets, because they just can't raise money, to be able to transition off of coal, some gas, to other things. And so we're going to be funding the transition to lower carbon.
On the face of things, Brookfield Renewable is part of the larger Brookfield family, and it's in fact owned 60% by the Brookfield Asset Management Company. Brookfield Renewable primarily heads out around the world buying up assets in hydroelectric, wind, solar, and very recently, nuclear and battery storage. Try to think of this company as a company that's doing the things that Tesla said it would do. Though I don't think Brookfield have any interest in buying Truth Social. And when I say Brookfield Renewable owns the assets, while it does own a few companies where it has great businesses and very good talent for developing those businesses, I mean that Brookfield Renewable is actually buying the dams, the turbines, the solar panels and the batteries that's used to sell energy to the utility companies and the governments.
We see some incredibly strong tailwinds propelling the industry. Connor discussed these in detail, but they include corporate demand for green power is growing significantly as businesses increasingly adopt carbon reduction targets. Government support continues to be strong. For example, recently, the Inflation Reduction Act was passed in the US, which significantly benefits renewable production.
It's currently the world's largest producer of hydroelectric energy, which pulls off big profits and cash flows that it distributes quite heavily back to its unit holders. Renewable energy is an area of economic growth that I both feel is important and is going to gain a lot of traction over the next 10 years.
And this approach has allowed us to increase our underlying cash flows at almost a 10% CAGR on a per unit basis over the last decade.
When you're buying something like Brookfield though, you have to understand that hydroelectric dams have a lasting life of around 99 years. So when I say I'm holding on for the long term, I might not be able to sell it ever. But hydroelectric isn't likely to be the cash flow leader forever. With significant growth in solar and offshore wind, Brookfield looks to be in a very strong position to buy further into this market with preferential buying rights on new developments and around $4 billion in cash to invest wherever they see fit.
We've already made a number of small initial investments totaling around $100 million. And while these initial investments are small, they're downside protected, and in exchange, we will get preferred rights to invest up to $5 billion of follow-on equity as those businesses develop and as projects are brought forward.
There's only one company really that I think is positioned with better cash and a better understanding of the energy market, and that's Berkshire Hathaway itself. I don't think I need to go too much into the benefits of renewable energy businesses because I think everybody kind of knows now where renewable energy is going and how beneficial it's probably going to be in the future. Plus, I'm not here to tell you about the benefits, I'm here to discuss the risks so I understand what I'm investing in. So, here's the risks. This is an investment company, so we should be very wary of the rising interest rates and the cost of debt and inflation. Rising interest rates should be the bane of any reinvestment firm. As the cost of borrowing increases, it's going to be harder to get a return on your investment.
There's a really interesting dynamic going on in the financial markets right now, which is there continues to be very, very robust liquidity and deep access to lending markets for renewables and infrastructure and high quality assets. So while underlying rates have increased substantially, we're actually seeing spreads hold constant, and therefore we haven't seen rates move too much for our project level financings. So while if interest rates continue to rise, those numbers might creep up a little bit. We don't expect them to have a material impact on our broader financing strategy.
So Brookfield is in quite a nice cash-rich position. It's not as brilliant as, say, Berkshire Hathaway, but it is in comparison to its nearest competitors. First, Brookfield has its debt structured in a very different way to how normal companies would structure their debt. But it's a very specific type of debt called non-recourse debt. This means that the debt that Brookfield owe isn't owed to the entire company. It stays with individual assets. This one is a little tough for my little brain to explain, but I'm going to try it anyway. If Brookfield buys 4 wind turbines for $2 million each and they finance them with $2 billion of debt each, the debt stays with each one of these wind turbines. This means that if one of the turbines becomes unprofitable and a bad investment, for whatever reason, the asset itself can go bankrupt and only the current value of the asset can be reclaimed by the debtor. The other 3 turbines are protected and cannot be claimed back. It puts Brookfield in a really good position to protect its profitable assets from its unprofitable assets. The only downside risk to this is it leads to higher fixed interest rates. So if things like inflation and higher wages become a problem, these assets could all turn negative individually quite quickly. I think that's the best way I can describe it. If anyone knows a bit more about that debt or that type of debt, leave it in the comments below and let me know what I've missed out. However, Brookfield is in the energy business, and the current high inflation we are seeing is focused on a few key areas of the economic market, one of them being electricity and energy prices. So Brookfield appears, for now at least, to be protected from inflation because what it's actually selling is the thing that's inherently inflationary. What a stroke of luck. It's getting a bit dark now. I'm going to have to go back in, I think, and finish this inside. I just wanted to do this bit next to the power plant because it seems quite significant. Another risk is that the short to medium focus of energy production could shift to fossil fuels in the next few years, especially while we're all still fighting Russia. The UK is ever so slightly turning back to coal, whilst Germany, where Brookfield has made a lot of big investments, is also considering how to get out of the Russian gas debacle. But of course I'm going to take this risk very seriously, which is why Brookfield is only going to make up 5% of my portfolio. And finally, the last risk, which is the management fee. Brookfield say they're dedicated to continuously growing the dividend over a very long period of time.
This focus on underlying cash flows has allowed us to deliver high teens annual returns to our shareholders for over 2 decades, while at the same time continuously increasing our distribution on an annual basis within our 5 to 9% target. A target that we remain committed to even while funding an ever-growing growth opportunity.
The dividend yield right now is currently 4.74%. And I started to understand why they were dedicated to this dividend, even though they're a growth company. It's because they're incentivized to keep it going. The management are compensated when they keep the distributions over 30 cents. I think it's a 0.25% fee, which is not bad, but it's also not very good, and the incentives there are a little bit off. That should worry a lot of investors, even the most hardcore dividend investors. I'm willing to see where this one goes, but it does mean I have to pay extra attention to how good the cash flows are and where the money is actually going. It feels very similar to share buyback incentives used by companies like Apple, where Tim Cook gets a bonus if he keeps the price over a certain amount. I'm sure it's been done before, but doing this with dividends is quite a new one to me. And the last big risk that I can see for Brookfield is the weather. Low wind, drought, even cloud cover can all affect how much revenue Brookfield brings in. It does make the top line revenue a little bit unpredictable. It's still going up in a very good direction, but this is a lot to do with mergers and acquisitions, not necessarily organic growth.
Or organic growth. Our in-house development has hit an inflection point in the last 12 months. In the last year, we've brought online over 2,000 megawatts of new generation capacity that will deliver over $40 million of run rate FFO going forward.
Luckily, Brookfield have invested in enough assets to produce more electricity than they can actually sell. So the downside, or the worst case scenario of their revenue, is actually quite predictable. The best case, or the top line case where we think Brookfield's revenues could go in the future, is a little bit harder to calculate. This will lead to volatility in the stock price as the revenues fluctuate up and down year on year. And there's no doubt that this thing is going to miss and beat estimates all the time. I plan to use this volatility as a buying opportunity to gather some units up in times when the business is perceived as being weak. That is a tough mindset to get into, but I plan on developing my knowledge about this company and developing my knowledge about their assets, so I do feel more comfortable that there is less downside risk in the long term. Which brings me on to valuation. Now, if you look at Brookfield Renewable Partners as a normal stock by looking at adjustable earnings, the stock looks horrible. But this stock is not one that you should look at as a normal business, because it isn't a normal business. It's basically a REIT. Therefore, we should turn to FFO and AFFO as good indicators of where this stock is. But the depreciation and amortization part of EBITDA allows Brookfield to put a lot of depreciation and amortization onto a lot of its assets. This brings down earnings but keeps free cash flow high. Brookfield, like many companies, had a very tough time through 2021. It did extremely well on the run up during 2020. This is the big energy boom where everyone was loving Tesla and everyone was loving everything renewable. But there are not many companies out there with this level of free cash and this quality of assets. Since the bear market started, Brookfield has lost 44.7% of its growth. A lot of it is due to this big free cash flow hole that we found here. A lot of it is just due to negative market sentiment. My job here is to figure out if this company has still got a lot of cash on hand, if it's still growing, and if analysts think that it's going to grow going into the future. Sales are going up nicely, EBITDA is going up nicely, and free cash flow is going up very nicely with it, except for this year in 2021. If we switch it to quarterly, you can see that free cash flow is very much starting to recover. And with the first quarter of the new year, it's already up a ridiculous amount on previous quarter. On the balance sheets, the total assets weigh up nicely against the total liabilities, and on the yearly, it's more clear that that asset growth is growing even better. It's even starting to show a little bit of a sign of compounding. From a free cash flow forecasting point of view, we've only got a couple of years, but this thing is currently sitting at a price to free cash flow of 9.59, and usually the free cash flow sits at around 17.55. Brookfield seems to look better than Zim in this situation because the estimated free cash flow is growing. Over the next couple of years, even though we've had this dip, we are going to recover. Energy prices look like they're heading in the right direction for Brookfield at least, and also the reinvestment is going to see continuous growth in this whole renewable space. And if it simply stays at its PE of 7.5, we'll see a total annual return of 11%. In fact, if the current PE ratio stays exactly the same, and after 2025 there's zero free cash flow growth for Brookfield Energy Partners, you will still earn a 5% annual rate of return. This is what we call margin of safety. If I go to the estimated growth of 12%, which is what Brookfield feels it believes it can grow its free cash flow, and then we see a free cash flow expansion up to 16.5 times free cash flow, we start to see real returns. 25% year-on-year returns from Brookfield Renewable Partners. This includes the dividend, and the dividend growth, I believe, goes up quite a few times over these next 5 years. So that's why I've added Brookfield Renewable Partners to my portfolio. It's currently 1.94% up. I wish I'd bought a little bit more. I'm planning to add around £3,000, and that would be around 150 shares in Brookfield Renewable Partners. I think this company in the next 10 years is due to start growing, and over the next 30 years we're going to see considerable share price growth. I'm hoping that there's a good enough management team in place here that's going to make me quite a bit of money in the future. Just my opinion though.
The real risk that matters is the risk of bad outcomes, is the risk of losing money on a permanent basis, not a negative fluctuation in price, but a permanent loss. Our motto stems from our work in credit. If we avoid the losers, the winners take care of themselves. I think Brookfield's a great investor. I think Oaktree is a great investor. I think we're going to work together very harmoniously and accomplish great things for our clients together.